$6 billion. That's the amount of money that Ghana stands to lose over 2 years if the International Tribunal for the Law of the Sea grants Cote d'Ivoire the injunction that it's seeking. Now, a ruling will be made on that later on in the next 24 hours. The thing is, though, these two countries for years have failed to agree, exactly where the maritime border lies between the two of them. What does Ghana stand to lose, and can it afford to take on such losses? We'll be answering that question tonight on Global Business Africa. Here's what's coming up. A pay dispute looms large in South Africa as the National Union of Mine Workers readies a 75% pay rise demand. And women in Guinea are resorting to basic processing techniques to preserve food and earn an income. Right then, let's start in West Africa. On the 25th of April, an international maritime court will be ruling on whether or not oil production in a disputed area of the sea between Ghana and Cote d'Ivoire ought to stop. Now, both countries so far have repeatedly failed to reach an agreement on exactly where the border, at least on the sea, lies. This area contains 3 oil basins, and stopping production now will cost Ghana billions in lost revenue. Katerina Vitozzi explains why.
Ghana and its neighbour Cote d'Ivoire have been locked in a dispute over a maritime border. Why is this patch of water so contentious? Well, it contains oil fields that are currently being produced on by the Ghanaian government and its partners. In September last year, the Ghanaian government launched official legal proceedings to find an end to the dispute. Analysts predict that when that decision comes in 2017, it will rule in Ghana's favour. However, in the meantime, Cote d'Ivoire want to see a halt to all production happening on the disputed site. And if that does happen, it could cost Ghana big. In 2007, when Ghana first discovered oil in its territory, the economy soared, although it has been stuttering for the past year due to a fall in commodity prices. The injunction could hurt it even further. Experts predict that it could lose up to $6 billion in lost revenue, and thousands of jobs could be suspended whilst work is halted. And it's not only Ghana that could be counting the cost. Oil company Tullow's share price dived 6% when the injunction proceeding was started by Cote d'Ivoire. If it does get upheld on Saturday when the decision is made, it could cost it a lot more. Katerina Vitozzi, CCTV, Accra.
Now, Ghana discovered oil in 2007, effectively adding to its gold and cocoa assets as well as its other major asset, at least at the time, a relatively stable democracy. The find offered a chance to catch up with the oil giant Nigeria and the regional West African economic powerhouse Cote d'Ivoire. Now, however, the country faces high levels of public debt, a currency that's depreciated sharply against the American dollar, and inflation that's as high as 17%. Now, the choice to seek arbitration in this border dispute with Cote d'Ivoire could prove even more costly for the country, a consortium led by Tullow, if a court holds development over there. Like most of Africa's sea borders, the one separating Ghana and Cote d'Ivoire has never actually been officially set.
After prolonged bilateral negotiation between our two countries without progress, the case was referred to the International Tribunal of the Law of the Sea, ITLOS, by Ghana. Cote d'Ivoire responded with a request for the prescription of provisional measures in accordance with Article 290 of the UN Convention of the Law of the Sea. Both sides have been heard by the tribunal on the provisional measures, and the order is due for Saturday, the 25th of April 2015. I can assure you that Ghana has a very strong case. We believe we will resolve our differences peacefully and focus on the important business of developing our countries.
Reminds you of the dispute between Kenya and Somalia over their maritime borders, doesn't it? Let's move on to South Africa. Next week, the National Union of Mine Workers will be submitting demands for a 75% rise in entry-level wages for gold miners. Union sources have told Reuters that NUM aims to raise entry-level wages from 5,700 rand to 10,000 rand a month. These demands, however, could lead to a protracted dispute, especially since profit margins in South Africa's gold sector are pretty thin. Spot gold prices are also nearly 40% off their historic peak in September 2011. The union has upcoming talks with AngloGold Ashanti, Harmony Gold and Sibanye Gold since its wage deals with them expires in June. There are strong perceptions within South Africa's mining labour force that the industry's earnings have not been fairly apportioned to workers as well. Now then, let's reel in Miriam Bemard and Angelo Coppola in for this discussion. Angelo, let's start with you. Would it be fair, or accurate for that matter, to characterize NUM's demands as a reaction to AMCU's fast and aggressive rise, both in members and effective power?
Raman, that would be a fair assessment. No one will admit it though, but the first rule of negotiations is that you go in high and you allow the other party to kind of beat you down. AMCU has a smaller member base in the gold sector, and it's probably going to be seen, or the move by the NUM can be seen as a defensive measure to counter AMCU's demands, which are due to come in just after the NUM's demands. If AMCU wants to keep and grow its membership base in the gold sector, it's going to have to respond. So the two unions are about to start this poker game of theirs in earnest. Meanwhile, though, the Chamber of Mines reminded me a little earlier on this evening that the gold mining sector had shrunk by 10% in the last 2 years alone. Raman?
Indeed, we'll be getting back to those numbers a little later. Miriam, let's come to you. How are bullion traders and sector experts responding to this news of planned wage demands by the National Union of Mine Workers?
Well, in one word, it's all about caution right now, Rama. You know, many experts are saying that they're watching to see exactly how the union will tackle this and what miners are going to be involved. We know that it won't impact Goldfields, as the union signed a 3-year deal with the company 2 weeks ago for a 21% increase for the lowest paid workers to about 7,000 Rand. But it's actually the upcoming talks between the unions and Anglo Gold, Ashanti, Harmony Gold, and Sibanye Gold, whose 2-year wage agreements expire, of course, as you were saying, in June. These are really the miners that are on the line. And investors and experts want to see exactly what both sides bring to the table. The expectation is the union will, of course, ask for that 75% hike. But as Angela was just saying, you know, that's going in high and seeing where they can end up. And talking to analysts here, miners will likely come back with a much lower offer, maybe lower than what we saw with Goldfields. So at this point, it's very, it's very gray waters, if you will.
Indeed, lots of things to keep a close eye on. But let's look at one particular gold mining deal that gold mining company that did arrive a deal with NUM. Goldfields arrived at an agreement for 21% wage hike, despite the fact that gold mining firms normally negotiate collectively. What happened here, Angelo?
Well, when I spoke to Goldfields and the Chamber of Mines, they both said to me that it made sense for Goldfields to actually negotiate separately, because the particular mine that they were negotiating around, the one that they've got left in South Africa, is South Deep, and it's highly mechanized. And that isn't the case with most of the other mines the other gold mines in South Africa. And a Goldfields representative I spoke to said that this agreement is for 3 years. And this is probably the most important part here, is that they would probably then review their collective bargaining position when the new agreement expires. And I got the sense from that conversation that they would probably walk away from the collective bargaining table. Raman?
Miriam, these demands for double-digit wage hikes, possible industrial action, we saw that quite clearly last year. Aren't they essentially just dampening industrial sentiments and, of course, sentiments about investments in new mining projects in South Africa?
Well, it's difficult to say, Rama, because, we're expected to see things slow down further within the mining sector. And China's, of course, demand as the top buyer is very weak now. We're seeing that. Growth rates in Europe are down to below 2%, and prices of commodities like iron ore, coal, gold, platinum, and copper, just to name a few, are at 7-year lows. It's a similar picture in South Africa, of course. Despite the inflationary pressures at 4% and rising labor costs, gold prices are still lower, trading around $11.90 an ounce, and the supply for metals is still outweighing demand. And as long as we have that issue, it will dampen sentiment. And of course, these ongoing issues as well will only add fuel to the fire. But we could still see new money put into things like technology within the mining sector, what's deemed by many as the secret success for mining companies, especially in terms of optimizing operational systems.
Indeed. Final question to you, Angelo. Walk us through the math behind Goldfields' deal, because the numbers here, frankly, are fairly interesting. Inflation in South Africa is relatively high, yet the company agreed to an entry-level wage hike of 21%, and bullion prices are nearly 40% off their 2011 peak. So how can Goldfields afford to make such a wage hike?
Well, Raman, there's no question the deal is attractive, or the wage arrangement is attractive, but it's about the skills level and attracting the right people into that entry-level category that they're looking to fill. The fact is that the average increase across the entire staff complement, which is around 3,500, is a more palatable 10%. The rationale there is that the staff are more skilled and they should be remunerated accordingly. But as a mine management pointed out to me, there's a shortage of skilled mechanized mining labor in South Africa. So that's the reason why they needed to hike that rate to attract the right type of people. Raman?
Indeed, we'll have to leave it there for the time being. Thank you for your input, Angela Coppola, live in Johannesburg, and Miriam Bemard, live in London. Now, let's get away from industries that dig things out of the ground. Kenya's biggest telecoms operator, Safaricom, says it's targeting mobile financial services and internet access as significant areas of future growth. Safaricom, of course, is 48% owned by Britain's Vodafone, and it's looking to boost data use and revenues through its 4G network and domestic digital decoders. The company says data use is the next large growth market after voice calls. Safaricom is expanding its 4G network at the moment, but it will continue to invest in 3G as well, since, let's face it, not many of us in Kenya do have 4G handsets right now. Safaricom aims to extend 3G coverage from 57% of its network at the moment to 75% of its network by the end of the year.
The demand for data in rural areas is much higher than people would have assumed a couple of years ago. And so, you know, wherever we have voice, we want to have data now. And of course, you know, you're always going to have some areas where it's just going to be voice because the commercial payback is never going to be there. But, you know, 75% of the country covered, the population covered by 3G is going to be pretty impressive. I mean, it'll always be the biggest footprint.
Up in North Africa, traders have called on the Egyptian government to reconsider the implementation of capital gains tax as one way of making the country's stock market more competitive, at least within the Middle Eastern region. Egyptian equities have been subjected to a new 10% tax on capital gains since last year. And traders say this makes it difficult for them to compete with other markets in the region that have introduced attractive incentives. Take the case of Saudi Arabia, for example. It plans to open its market up to foreigners for the first time this year. That's a move aimed at reeling in a lot more international investment.
The government should start applying some procedures that can attract and motivate the investors, as investors are less attracted, and that's reflected in the low volume of trading. We see other countries like Kuwait have exempted foreign investors buying in its stock market from taxes. Also, Saudi will allow foreigners to buy from June.
Now, we should point out, of course, this is Friday. The Egyptian markets were not trading. But Nigeria, Nairobi, South Africa, they're still very much active. Some interesting numbers coming through from Nairobi. TransCentury released its 2014 fiscal year results. Dismal performance, frankly, a loss of 2.3 billion shillings. Management attributed that loss to the sale of its stake in Rift Valley Railways, plus a few other things as well. There was a 36% drop in revenue churn from its engineering division because some of its projects did stall. Coming up next, we'll be looking at the challenge of housing Kenya's rapidly growing population. And now you can actually go to Robben Island without being there in person. We'll tell you how next.
This report by the African Green Revolution Alliance says climate change will slash food output. Within the next 30 years, the number of malnourished people in sub-Saharan Africa could jump nearly 40%.
Welcome back. 15 minutes in, you're still watching Global Business Africa. Now, Kenyan property developers say that the national government has to better cooperate with industry players if it wants to improve housing affordability and access. A local industry report shows advertised land prices in Nairobi's 9 fastest growing suburbs have actually gone up 5-fold since 2007. Official data estimates that Kenya has a deficit of about 200,000 housing units a year due to a combination of rapid population growth and urbanization as well. However, soaring house and land prices have led to a slowdown in the number of new projects being announced in the nation's capital, and developers' profit margins are being squeezed. Industry players say that's being compounded by high effective tax rates, a lack of access to finance and restrictive property laws, all of which hinder efforts to improve home ownership levels. Now, earlier today, I spoke to Elizabeth Monge, Chief Executive Officer of the Kenya Property Developers Association, to figure out what developers are doing to make the dream of owning a house a lot easier to reach for the average Kenyan. I started by asking her how buyers acquire their properties and what percentages are acquired through mortgages compared to cash purchases.
It's a concern for developers to access affordable financing, even for doing their own developments. And one of the things actually that we're engaged in is trying to work with chamas and SACCOs, because what their members are finding is that they're having a problem accessing affordable financing solutions from the conventional methods that are available. And of course, that definitely influences the sort of prices that they put on developments that they are involved in.
Indeed. For the sake of our viewers who are not familiar with what chamas are, I should just essentially say the collective investment schemes. Land prices in Nairobi have soared significantly over the last couple of years. Has that had the effect of pushing your members out to the periphery of the capital, to places like Kitengela, Kiambu, Kajiado, Ngong, and so on?
It certainly has influenced our members moving to the periphery areas of the CBD, because what Kenyans are looking for is to not just buy a property or not just buy a piece of land, is to buy a piece of land that is close to infrastructure, that is close to basic social amenities. And what we're finding is that the urban cities are actually condensed. So therefore, there's the need to move to the periphery. And though it is affecting the prices, Rama, I must emphasize the fact that this depends on where also the pieces of land are. Of course, if the piece of land is near an infrastructure, then it definitely would make the prices go higher.
REITs, real estate investment trusts.
Yes.
The NSC and the CMA have made quite a bit of noise about introducing them into the market.
That's right.
Have your members taken them up?
They have taken them up, and it's definitely of interest to us. These rates were actually being discussed in a recent conference that we were co-organizing called the East African Property Investment Summit. And it is hoped actually by the end of this year that the rates would be in the NSC. Definitely it would be of interest even to Kenyans as well, Kenyan investors. The only challenge that is faced is that the minimum charge that is actually being implemented is a little bit high for the ordinary Kenyan. Investment bankers complained a lot about the introduction of capital gains tax in the 1st of January this year. Has it affected your members? It certainly has affected our members, although not in as large a scale as it has affected the stockbrokers. Our members are affected when they resell their developments. However, I must emphasize the fact that our members are paying other taxes that, when added to capital gains tax, makes it quite high. They pay compensating tax. There are also certain aspects of CGT that are not quite clear. And we had a session, we had a forum that was interactive where we brought together the Kenya Revenue Authority to try and discuss this CGT. As KPDA, I must emphasize, we are not against CGT. All we are saying is that we would like for the implementation process to be smoother and for it to involve all the stakeholders who are affected by CGT. Right, Robben Island. You're familiar with that, right? It's the island where Nelson Mandela spent 18 of his 27 years in prison. Here's the thing though, now you can go there virtually. Google has put the island on Street View, and the firm hopes that this data can be used as a teaching tool in schools across the world. Some also hope that this virtual access to a historical landmark might give South Africa's tourism industry a shot in the arm.
Robben Island, just off the coast of Cape Town, has been a leper colony, a mental hospital, and most infamously a maximum security prison built to hold political prisoners. This was also where Nelson Mandela spent 18 years of his life. And usually you'd have to take a ferry from Cape Town to see this famous landmark, but not anymore. Google now gives a street view of Robben Island that allows you to take a virtual visit.
It actually inspires you to come to the island. It's not that it's a replacement of the actual visitor experience. Actually, it's enhancing it and making sure that people want to see more So that's what, because like I made examples. If you want to visit a hotel these days, you go online, you look at what it looks like, the rooms that it provides and everything before you even make a booking. So that's what we are trying to do. So to say, let's have a visual tour, let's make it possible for people to interact with the island before they come here.
Street View is a facet of Google's online maps that presents 360-degree photographic images taken at street level in more than 55 countries. The navigational tool attracts more than 1 billion visitors every month. Mapping the island wasn't without its challenges, because Street View usually uses cars to map a place. But as the prison is on an island, it just wasn't possible. Instead, armed with tripods, technicians walk the island to capture the imagery. Over 100 people, including former political prisoners, helped map Robben Island.
I think it is. Anybody who's familiar with our Street View technology, for instance, will be very, very familiar with the kind of experience that you're going to have when you go to the Robben Island Cultural Institute experience. It's very, very similar. In fact, what's different is that there's actually more information available, whether it be images of, for instance, letters that have been sent by prisoners to their families during their stay here, or even just photos of particular artifacts that are interesting on the island itself. So it's Street View plus a little bit more.
So, I mean, Robben Island is an iconic place. It's symbolic to the freedom of South Africa. And when we started mapping South Africa and putting a lot of the areas and parks on Street View, it made perfect sense that Robben Island would be one of our historical collections. And Robben Island Museum as well, they were so happy to come on board and partner with us. Essentially, we provided technology, they did the rest. They brought their story to us, and we were only too excited to put it together.
It's a vital part of South Africa's history that can now be accessed on desktops and mobile devices across the world. Valdi Karelsa, CCTV.
Now, 32 Somali nationals have gone through firefighting training in Mogadishu to boost their ability to respond to emergency scenarios. The country has been equipping its firefighters over the last 2 years. The latest skills edition is expected to increase not just the firefighting and emergency response capacity, but also boost the operators' confidence as well. This month-long training covered firefighting and emergency operations, search and rescue, the use of breathing apparatus, and conducting rescue operations in multi-story buildings, in aircraft and on aviation premises as well. The project was backed by the United Nations Support Office for AMISOM, AMISOM itself as well, and the Mogadishu municipality.
They're doing some drill and demonstration, and it's very good, the way they run. And I'm sure they can help into the people and also the airports in the Somali. And I'm very proud, and I'm very happy to see. And today in my team, they doing a very great job.
It has just proved to us that they're really very competent people, and they took the training seriously. And as the mandate continues with that and requires that we should do local capacity building, my team and myself will continuously continue to help the Somali people in terms of training and providing skills for them where necessary, especially in aviation.
Quick run through commodity prices here for you. Some interesting developments across the board today. South African bourses, of course, hitting some interesting highs, driven by commodity producers like Kumba. Seems there's a bit more demand for iron ore. However, as far as oil is concerned, we're still well above $64 a barrel, especially on Brent crude. Interesting developments as well. Stateside, the fall in American rigs drilling for oil actually accelerated this week. According to the Baker Hughes rig count, drillers idled 31 rigs this week. That just leaves rigs, about 700 of them, active and operational. That's a low that takes us all the way back to 2010. In agriculture next, women in Guinea are resorting to basic processing techniques to preserve food and earn an income. Welcome back. Now let's wrap up the final part of Global Business today with a dive into agriculture. A group of women in Guinea have come up with a low-tech processing solution to preserve fresh food, which normally would have gone to waste. In Grassroots tonight, let's introduce you to a group of women in West Africa who are using the skills they learned at a canning factory.
After being sacked from a cannery factory in Mamou City, Guinea, this group of women saw a gap in the market. They put the skills they had learned at the factory to good use.
We see agricultural products rot without being processed. With tomato, we said, as when the canning factory was working, it was tomato. We decided to revive the activities so that finally Guineans can consume what they produce at home.
Determined to make it through tough economic times, they transform fresh produce into canned goods. But without sophisticated machinery, the process is extremely labor-intensive, as they have to wash, crush, filter the tomatoes by hand.
Our difficulties are enormous. We have no means to do the work. We have no machinery to scrap the tomatoes or the pound, and we have no other means to cook it. You have to use pots, and you can see how it hurts.
Diallo and her group are now looking for investment that they can use to buy the necessary machinery. Their products have been well received in the market, but a lack of brand identity has led to their idea being replicated. The women's initiative in Mamou comes at a time when there is growing demand for and very little supply of processed vegetables. And with large quantities of fresh vegetables available for processing, they are now hoping their efforts will be spotted by investors and that they will be able to expand their business. Maria Galang, CCTV.
Quick run through currencies before we wrap up the program. The Kenyan shilling really is going to be under quite a bit of pressure next week. It's at the end of the month. Normally you have a ramp up in dollar demand at the end of the day. And on top of that, at these particular levels, now we have a fairly clear idea of what the budget will be looking like in June. The sheer amount of borrowing the Kenyan government will have to undertake in order to finance its budget will have a negative effect on that exchange rate. We'll have to wrap it up there for the time being on this edition of Global Business. Do remember you can send your feedback on this program to globalbusinessafrica@cctv.com. And of course, when we're not on air, Facebook and Twitter are your ports of call. Thank you so much for watching. We'll see you right here on Monday. See you then. I'm Raman Yan.